folks, and welcome to this video. In this video we're going to have a quick look at a methodology that can be used together with the indicator to identify trading setups on any time frame. So essentially all we need to do is we need to identify the way we wish to trade, and this is something that'll primarily fit to one's personality. I'm more of a longer term trader, so position trading and swing trading, but some people like to feel the action and the pulse of the market, and then they would be maybe more comfortable about moving down to the smaller time frames. And when I do this, it's important to note that this will affect the time frames that we're using in order to assess the possibility of a trade. And so in this setup we have three time frames. We have long term, medium term, and the short term being the entry time frame, as you can see here on this slide. And for day trading, the long term would be the daily, medium term would be the 4 hour, and the short term or entry time frame would be the 1 hour. Okay, and so then once you've set up your charts like that, and I'll do it like this, which I've done. This is the day trading where we have the long term, the medium term, and the short term, and I have the instance of the indicator running on each time frame. Well, then I have this series of steps that I like to follow. Okay, and so the first one is pick a pair. So let's do that quickly. We'll go here and we'll pick a pair, and we'll just say, for the sake of example, let's have a look at the American dollar, Canadian dollar. We have the hourly price action, we have the 4 hour, and we have the daily. Okay, and then we go to the entry time frame, which is this one, and we zoom out all the way, which is the next step. So we'll do that. So we go to the entry time frame, which is this one, and we zoom out all the way. Is this going up or down? It's going down. Okay, you can see we zoom out as far as we can, which gives us about 1,500 candles. Okay, so 1,500 hours of trading. Is it going up or down? Well, looking at this, I think we can say that this is going down. Look for extended range candles. This is what I call price imbalance candles. Just here we have the bleeding edge, and we have this area here where we had sideways price movement, and then we had big pushes lower. Okay, so we found that around here. The candles identify an area of accumulation or distribution if price is moving lower, and we have that just here. An accumulation distribution is simply a pause here. This is where we have the pause prior to this departure. Then you go to the next step, which is draw the area. So if we were to draw the area here, we would draw an area that looks something like this, and we want to focus on this area here. We choose the lowest body in the area of, in this case, distribution, which would be this blue candle just here. I'd mark the low of the body, and I'd move the box to the high of the highest high since then. Okay, so this would be the area that we would look to trade. Then before we do anything else, we want to pay attention to something that is very important, and that is how strong is this area of supply. And so we can answer this question by looking for historical lows that price was able to remove. And if we look just here, we actually had price doing this, where we had price moving higher. We formed a continuation pattern, a pause in price. This one went higher, this one went lower. Price pulled back, the slingshot I referred this to, telling us where the edge of the buy zone is, and then price went higher, moving through this one here and this one here. Okay, price poked back into the buy zone once, price came down, we moved sideways, and now this area has been removed by this area of supply. So this is qualified as an area of supply. So we mark that off like that. And then we go place entry, stop, and target. This would be our entry. Our stop would be placed just over the high of this box, and our target would be placed at a logical opposing side of the market. So we would look for an area of demand at which to get out of our trade. Okay, so our entry would be here, 126.47. So we go 126.47. First of all, we go here. This is a sell limit because we're selling, and it's a limit order. 126.47, and the stop would be up here. So this is 126.70, 126.70, and the target would be, let's maybe put something here. So this is located at 125.85. So 125.85. And what we'll do here, we'll put H1, I put H1S, which is like hourly supply, and then we would say do it. So now we can remove these lines, and we can see that we have our entry to sell here. Move this up a little bit more. Okay, we have our stop just up here, so we're risking €3 for the potential of taking out €8.50 roughly. And then we have this little step-by-step process. Pick the pair, go to the entry time frame, zoom out all the way. Are we going up or down? Look for extended range candles, identify the area of accumulation distribution, draw the area, place entry, stop, and target. And then the process continues. So now we have that. So now we can move to something else. Pick a pair. We've picked the Euro USD. Go to the entry time frame. Zoom out all the way. What way are we headed? Looks like we're headed south. Okay, zoom out all the way. We've done that. We're going up or down. We've done that. Look for extended range candles. Where do we have extended range candles? We have extended range candles from this area here. Okay, and this is interesting because we had a box. Okay, price came up to it. We tested it. We started to move down into it, and then this one cut through it. So this is the area that we would look to trade at, just here. Anywhere within this price window here, from the low of the previous box that was removed to the high of the area of supply that removed it. And if there's no clarity on this time frame, then you go up to a different time frame, and you can see here on this time frame we had a price point here that was respected, and now it's removed. The area that removed it is here. Okay, we'll just mark off the area, this big area here. Okay, so this gives us the 120.33. So we go here and have a look at the daily and see if we have something similar there. And here you can see it even clearer on this chart, where we have the continuation pattern. Price tested it once, twice. This area removed it. So this is the area we trade at, and the software found it beautifully for us. Okay, so if we were going to do that, entry, stop, maybe a little bit higher, and the target at an obvious place of resistance. And you can see there's no demand down here, so price could easily continue to move lower. Price is already poked into here. We have demand being supply being respected, demand being consumed. As you can see here, as price wriggles, and we're also reacting off a daily area of supply just up here. We zoom out a little bit. You can see it was here. So this box was marked off on the chart when one of these candles just here. 2018, we were told to sell at this level. Price goes all the way down here. We come up to that level, and then we go. So we have loads of time to wait for price to come up to this area. What the software is doing, it's showing us where these areas are. Okay, we had this area here. Price left. We tested the area, and it went up. Okay, we had this area here. Price went up. Price came to the area. It went up, and then it removed it. Then it went down. Okay, so this is important to us because we need to answer the question, what area of demand consumed the supply here that removed this demand? And you can see that if we just mark this area off like this. Okay, it was tested once. Okay, and then price managed to go through it. You can see price traded above that area. So then you have to find the area of demand below this area of supply and trade that. Okay, so the software found it for us just here. Price poked into it one time, we went through it, the slingshots pull back, and then we leave. Okay, and the same thing goes on and on here. So we had, you can't really see it on this time frame, but we had this area just here. Price went north, we came down, and we moved higher. An easier way to use this is to focus on significant highs. Okay, we had a high here, price turned around and went very far away. We had a high here, price turned around. So there's resistance at this price point, but from this area, this price window here, price was able to trade above these highs. That's telling us that we have an interest in buying from this price window here, anywhere from the high to the low and lower. Okay, so the entry would go here, the stop would go just here, and the target would be some obvious opposing area of supply. Okay, and so this is how you can use the software to do the same thing, and this is happening all over the place. We had this one here, price formed this area of supply, price went down, we rallied, and we just cut through it. But notice that this area of supply was removed by a pause in price, and we have that pause in price here, which is below, but we have an origin of push, it went through it up here as well. So we have this continuation pattern, and we also have this area of demand just here, so you could mark these off here. So you have this one here, then you have this one here. Okay, so price cut through it. The origin of the move that removed the supply is here. So this is where we'd target a buy. It was tested once, twice, 3 times, and now it's gone. The area that removed it is just here. Okay, price went through it. What area? Where do we have a pause in price prior to this? We have the pause in price just here. So this is the area that we'd look to buy it. Okay, price goes up, pokes into it, and then we leave. And so you're doing this thing all the time. And so the purpose of having these boxes here like this is it's showing us where we have areas of supply and demand that have been historically removed. Okay, and here we have another one that's actually just about to play out, where we have an area of supply that's done damage because it's on the chart, but it's been removed. Okay, and this area is valid because it's done damage to historical prices to the left. It was tested once, twice, close 3, 4 times, and then this area formed below it, and then price went through it. So this is the area here that we would look to buy at. Good, I hope this was interesting, and I hope it helped clarify the methodology. If you have any questions, please let us know. Thanks for watching.